Thanks for clicking! The Bank of Canada's rate cut was like bringing a butter knife to a gunfight. This according to a recent article by Rob Mclister in the Financial Post.
Please, sir, I want some more.
Indeed, the article, which is making its way around, comes on the heels of a dismal showing in Canada's real estate markets, with sales falling in many of Canada's biggest cities. As such, says Mclister, Canadian real estate and over-leveraged borrowers need a bigger savior than a 25 basis point rate cut.
Mum!
Yeah, kinda comes off like that, doesn't it? Regardless, a closer look at Mclister's numbers and his reasoning reveal that multiple rate cuts coming from the Bank of Canada might not be the savior that the real estate industry is promising. So what I want to do today is go over Mclister's article, delve into the argument that more rate cuts could help with housing affordability, take a look at what the data actually says, and then discuss some implications. We have a big couple of weeks coming up with Canada's inflation data set to be released next week and the Bank of Canada's policy announcement set to be released the week after, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this article. Onto the article. As mentioned, Mclister argues that with real estate inventory growing and affordability still atrocious, the Bank of Canada's rate cut was like bringing a butter knife to a gunfight. And there are two very quick problems with this. First and foremost, I'm not sure the Bank of Canada actually wants to win this fight. As it's said on multiple occasions since the spring, it's concerned that rate cuts will reignite the housing market. In fact, Doug Porter of the Bank of Montreal said that although the real estate industry and home sellers might not like it, a sleepy real estate market is probably exactly what the Bank of Canada wants at this point. And yeah, the central bank really doesn't want to see the market take off, as that brings with it all sorts of inflationary pressures. As such, the real estate market not taking off probably works to increase the likelihood that the bank can cut rates again, which would actually help affordability for people that already own a home, which is what the real estate industry genuinely is concerned about, right?
Well, no.
Yeah. And second, the notion that multiple cuts coming from the Bank of Canada would help with housing affordability is questionable to say the least. Using average mortgage rates for the past few years as listed by Stats Canada and inputting the benchmark price into the mortgage calculator that we used a few videos ago, we can see that housing affordability, that the average mortgage payments, have actually been getting better since the summer of 2023. In fact, in March of this year, mortgage payments on the benchmark price home were back where they were in the spring of last year, before the housing market took off on the anticipation of rate cuts coming from the Bank of Canada. How anyone can look at a chart like this, where we see rising rates slowing down price growth and mortgage payments coming down thereafter, while also recalling headlines like this during the lower rate environment, and can then say to buyers with a straight face that rate cuts are going to improve affordability, is beyond me.
It's easier with practice.
Yeah. Mclister definitely isn't alone in this assertion. We've heard lots of this before, but the data just doesn't show that to be the case, that a drop in interest rates increases affordability in the medium term. It might for the first few months, and then we all know what happens thereafter. And on this, Mclister accidentally says the quiet part out loud. The psychological boost from the bank's initial cut can only take the market so far, and as such, what the real estate market really needs is to wake up the sleeping giants. Sidelined homebuyers. So, one rate cut wasn't enough to induce the FOMO that we saw last year, so what we really need to see is more rate cuts to get this party going again.
I am looking out for you in this thing, okay?
And Mclister says that there are ample sidelined homebuyers, with Canada seeing its population grow by 1.27 million in the preceding year, 1.06 million the year prior, and 0.5 million the year before that. And this, the immigration causing supply issues, is just a little simplistic.
It's the best I could do.
While the Canadian population may have grown by 2.9 million over the past few years, which Mclister says is more than the population of Manitoba and Saskatchewan, that's not 2.9 million more homes which are needed. How many of those newcomers are couples, children, etc.? How many new households have actually been formed? Further, given that the median income of newcomers, right now at least, is sitting around $39,000, still lower than those who are already living here, I'm not sure that this increase in the population represents a one-to-one increase in demand that is being posited by the real estate industry. Now, obviously, immigration's effect on housing demand isn't as simple as that, but it's also not as hyperbolic as being posited by many in the real estate industry. If immigration is so high that our current housing stock is bursting at the seams, then why are sales so low when fixed rates are right about where they were 1 year ago? Regardless, let's be clear on the reasoning in this article. The Bank of Canada cuts rates enough to awake these sleeping giants, the 3 million newcomers into Canada, and then housing becomes more affordable?
It adds up.
The data and common sense says that's probably not the case. But let's say that the world being posited by Mclister exists, that the Bank of Canada can cut rates, saving borrowers' wallets and keeping home prices buoyant. Saving borrowers' wallet and keeping home prices buoyant.
You need help.
So, if the Bank of Canada is going to cut rates, when can we expect them? On this, Mclister takes the time to point out that since the dawn of inflation targeting, there have been 5 instances where the bank cut by 100 basis points, and it takes an average of 3.2 months for them to do so. Yeah, in this reasoning, this math is even a stretch for the real estate industry, which is saying something, as 3 of those 5 100 basis point rate cuts came in the aftermath of major global economic events: COVID, the global financial crisis, and the dot-com bust. And those 3 are going to massively skew the average time that it takes the Bank of Canada to cut rates. It's also going to be heavily skewed by the inclusion of the 1990s drastic cuts after the 1980s highs, when the unemployment rate started at 7% and was on its way up to 12%. If the unemployment rate is heading to 12%, I'm not sure that a few rate cuts here or there, even 100 basis points, awake 3 million sleepy giants. Now, Mclister does admit that we shouldn't expect 100 basis points worth of rate cuts by September, though for some reason he says it's not out of the realm of possibility, so I'm not even sure why he would bother to take the time to include the 3 heavily skewed outliers in his data. Regardless though, Mclister says that according to current market expectations, we shouldn't expect the next 75 basis points worth of rate cuts to have occurred until April of 2025. And that, at least, could in fact be possible, though it's going to be heavily dependent on the economic and, more importantly, the inflationary data. But I bring all of this up not just to poke fun at the circular reasoning that gets pushed by the real estate industry. In fact, I think Rob Mclister is actually a mortgage agent.
Aha!
But rather to show that this is the type of narrative that gets pushed, that the Bank of Canada hasn't cut enough, for whom I'm not sure, but as soon as it does, to help with housing affordability, which the bank doesn't want to do, it said as much, millions waiting for those cuts jump into the market. Like, it doesn't make any sense, and it gets pushed nonetheless.
It doesn't have to make sense.
Yet we know that this is demonstrably not the case. That A, the Bank of Canada does not want to bring anything more powerful than a butter knife to that so-called gunfight, and B, when it does bring something more powerful, that probably, if the data tells us anything, won't help with housing affordability in anything but the short term. Maybe a few months if last year is any gauge. The industry continues to tell would-be homebuyers that rate cuts are going to be in their interest, that that's going to help them get into the market. Yet the data says very clearly that's not the case. It says so obviously clearly that's not the case that those forecasters at this point are getting a little bit laughable. Mortgage payments on that benchmark price home are lower than they were a year ago, and buyers still aren't buying. Buyers still aren't jumping. That tells me that they're not waiting for interest rate cuts to make housing more affordable. They're waiting for prices. With that said, whether or not the Bank of Canada is going to deliver something more powerful than a butter knife at its next announcement will obviously be dependent on next week's inflation data. We will have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.